Everything's working fantastic. So the NASDAQ took a little bit of a dive today, but it really, I mean, in the grand scheme of things, it does not matter. We'll take a look at that. So the dollar notice was way down. So the dollar's been helping to support the markets, but they're recovering a little bit now. Oil is back down below 76 because the inventory report was not very good. We'll take a look at that. And what else is happening? We had a spiky in the VIX and a little bit of a spike here, but on the whole, everything's still calm. Oh, and I'm already falling asleep. That's a bad sign. Drink tea. Because I've been up since 5. I mean, it's like, it's probably not the best time to do a webinar. It's all right. Drink my matcha tea and I'm good to go for another couple hours. All right, let's see. Dun-dun-dun. See, the problem is I settle into this routine on Wednesdays, and everybody knows that they can't reach me from 1 to 3. So everybody calls me first thing in the morning on Wednesday for whatever business. And it's crazy. It's like such an exhausting morning. So where are we? We were going to look at some stuff. Yes. Oh, I know what I was going to talk about. The proportional drops. That's important. This is what I like about FinViz because it's really easy to do this. You just zoom in and zoom out. So you got your hour, you got your intraday and your hourlies and you can do this when you make a bigger chart too. And so you look at the hourly chart and you say, oh dear, look at the Dow, first of all, is not being bothered at all. The S&P, the NASDAQ taking nasty falls, the Russell taking a fall, the VIX spiking up, but you gotta move back a little bit and put these things into proportion. So now you see that this is barely a noticeable blip on the S&P. The NASDAQ, you can see it on a daily chart. The Russell, not really. It's sort of consolidating on that 2000 line. And if you pull back to weekly, it's not even there. The S&P, because it's still positive for the week, is still green. The NASDAQ turned red for the week, but it's still up about the highs of where it skipped to for the month, right? And you're going to see that on the monthly chart. Look at that. This is a positive month. This is a positive month. When you see, this is the thing. When you look back at the months, right? You don't remember that we had this terrible thing and this happened and whatever. All you remember is how did the month close. We're solidly positive on all our months. So Russell is down for the month, but as I said, consolidating on that 2000 line for 2 years now. 2 years consolidating for breakout. It will eventually pop over it and go up, unless the entire economy contracts, which is not likely at this point. So that's the monthlies. The weeklies are a little bit more telling, I think, for looking at things, but you look at energy and oil is just sort of trying to break back over 80, but that's going to be very hard. Look how long it's been trying to break over 80 before. That was last spring, right? Trying to break over 80 all spring, finally gave up and took a big dive. Then it was a buy though. When we got down to like close to 65, that became a good buy for oil. And then the 70 line held up and then made another run up. Natural gas right now is a buy, and we're going to want to buy some UNG because that's too cheap. That's getting into, as I said yesterday, it's getting into the cost of production. A typical natural gas well is going to be like a $9 million, $10 million investment, and then you're going to pump about 20. Nope, I'm sorry. You're going to pump about, let's say, $30 million worth of gas out of it, but it cost you, wait, 20 million, 40 million. It's going to cost you $40 million. The cost of the well is 9. So let's say that you're going to pump at least $20 million worth of gas out of it, but your cost of the gas you produce is $1 per BCF. So half the cost is going to go into, or $1 out of the cost, which at $2 is half, goes towards the cost of the production on a daily basis to get it out. So you buy the equipment, you put the equipment down, you drill the giant hole, you do all the stuff, and then the cost of day-to-day extracting the gas, that's also a running cost. That's going to be $1 per cubic per BCFs. And so when you're at $2, you're spending $9 million on a well. You're paying this much to pump it out. You're going to pump out $18 million worth or $20 million worth. But the problem is, if at $2, you're only going to make 100% profit over the course of like 5 years of pumping. So that's 20% a year. That's barely worth doing, right? That's a bare return on investment. So at that point, there are more attractive things to do with your $10 million. So this is how the thing self-regulates, because you get to a certain price point, it's no longer worth drilling new wells. Natural gas wells deplete on a regular basis. There are thousands of them being used around the country. So they deplete on a regular basis. And that means that every week there's 50, 100 that go offline completely and stop pumping. So if it's not worth starting a new well, and by the way, when I say starting a new well, it takes a year to build the well. But if you hit a certain price point, people don't put money into starting a new well because they're not going to see the return, because you're going to tie up $9 million for a year. You're not going to see a penny for a year. Then a year from now, you start producing gas, natural gas. You're going to recoup most of the $9 million in the first 3 years. That's pretty much because you pump a lot more gas out. But then the profit portion goes over the next 10 years, really, and that profit is slow. You're pumping a quarter or less than a quarter of what you pumped at the beginning of the cycle of the well, because it depletes very quickly. And so it ends up costing you about a buck per BCF to extract it, in addition to your $9 million sunken cost. So investors look at that. It's a very, it's like an insurance, it's like an actuarial table. It's just like they look at that and say, nope, because it's dumb, because you're not really looking forward. But they look at it right now, and at $2.11, they say, no, that's below my break-even point. That's not worth me investing in. It's got to be $2.20, $2.25 before I'm going to put money up for a well. That's silly, because in the course of the time you're building the well, and whatever the price changes, but they react to the current price as the investors. So what happens is, so every month, a certain amount of wells go offline, and if they're not being replaced, there'll be a gap. Even the gap is like, so in other words, people who decide right now not to invest in wells this month because it's too cheap, a year from now, it creates a 1 month dip in production, because no new wells came online to replace the wells that go offline in a year. This month, that gas is low, new wells are coming online regardless of the situation. Now that's interesting too, right? Because the new wells that come online, we're anticipating these gas prices, right? So a lot of people put wells online when prices were high, and now those new wells coming online push the prices down. So there's a real ebb and flow to the situation that you have to be aware of. So these people made decisions to drill wells here when gas was wildly profitable, but those decisions are turning out to have consequences. See, and you can understand where they're at, because we weren't below $4 from mid 21 until early 23. We were not below $4. So a lot of people said, oh, I'm going to invest in natural gas wells. Not only that, though, we had the LNG situation and all that. So a lot of wells were put into production up to and including the first quarter of 2023, because everybody, when it first goes down, they go, oh, it's just a blip, it'll come back. But then after it doesn't come back, they start saying, oh, this is kind of a problem. But it's too late, because these wells, all these wells that were started here, are online now and producing gas when there's a glut. And what's really killing it is there have been delays in the export terminals. So here we had more export terminals than we had new wells. Now we have more new wells than we have export terminals. It'll all even out and work itself out eventually. So, at this point down here, I just say, you know what? this is as cheap as it's going to get, because that's your production cost basically for the gas. All clear? And you know, that's true with oil too, and especially with oil, because you have oil sands where the cost of production is pretty high compared to, you know, the Saudis. The Saudis, they've got so much oil in the ground that it's like it used to be in Texas. Like you stick a straw on the ground and oil comes out. So they got so much oil, and their labor costs are cheap and everything else. So their production cost of oil is not even $20. It could be $10. So they don't care how much oil is, they're going to make their money selling it. On the other hand, when you're into like an offshore drilling rig, your cost of oil production could be $50-$60. And that means if oil isn't $70, what the hell are you doing? It's a waste. It's a waste of time. You got to have a crew out there. You know, you got to have people on there. It's a dangerous place. It needs to be a lot of insurance. You have hurricanes and sea catastrophes, and your well can go offline. You could have a BP type spill that cost BP $15 billion or something like that. So, you know, so that can really put a dent in your profit. So you have to have some massive insurance, and the insurance obviously isn't cheap, because all it takes is one little disaster and they're in trouble. So again, there are base production costs, and it's not oil in general goes offline, but first the offshore stuff goes offline, the deep sea rigs go offline, then the tar sands will go offline, and then the shale stuff goes offline. So there's a tiered pricing on oil, but they cut it down. They'll cut it off real quickly, especially, like I said, those deep sea rigs. Once you get below $75, there's no point in crewing the rig. You'd be better off just leaving it, because what, you're going to leave it in the ground. It's still your rig, so you leave it and you wait until it's worth using it again. But then you have long-term maintenance costs and things like that to deal with also. Everything is connected. It's very interesting. You know, the dynamics are crazy, right? And then you got the cost of shipping, and that goes up and down, and so on and so forth. There's a lot of crazy stuff going on. So anyway, natural gas, good investment. What else is going on? Metals. How's metals looking? So gold. I mean, gold was here. You know, it's down, but on the whole, that's why we like Barrick Gold. I mean, last year, first quarter, gold was under 2,000. Now it's over 2,000. And in the fourth quarter, more importantly though, in the fourth quarter of last year, that's down here. So, you know, we'll take a longer look, take a better look at it. So what's the fourth quarter? It's October, right? So October, November, and December, we didn't get over $1,800. So now October, November, December that they're about to report wasn't below 1,900, was a little spike, but it was up and down. So it wasn't really below 1,900, and it was heading more around 2,000. So we're more than 10% higher than last year in the cost of gold. So even though Barrick Gold told you their production was not as good as they thought it was going to be, it's at a 10%. They're selling it for 10% more than they sold it for last year. So that should be actually good. I think that's going to be a good upside surprise on earnings. Oh, speaking of earnings, all right, are we done with charts? Let me see before we move on. How are the other metals doing? Copper is coming back, which is interesting with all the China turmoil, but copper seems to be holding on nicely. Oh, we should look at meats and grains. Softs. Cocoa is still going crazy. Cocoa has been steadily up and up and up because the heat is killing the crops. So there's a huge strain on the cocoa supply, and the demand doesn't change. And also it's inelastic pretty much, because you're not going to not buy the Snickers bar because it's $1. You know, it's I don't even know what things cost anymore. $2.50. I know M&Ms are like some ridiculous price, like $2.50. So even though they're $2.50, I still buy a bag of M&Ms when I'm in the 7-Eleven and I see a bag of M&Ms. I'm like, oh, I'll buy that. You know, peanut. I like peanut. So I'll still pay for the peanut M&Ms especially in Walgreens, because in Walgreens they a lot of times have like a 2-for-1 sale. Then I always buy it when it's 2-for-1 because I'm like, I'm definitely gonna eat these eventually. But anyway, so the demand is inelastic, because if it's $2.50 or $2.75 or $3, I frankly wouldn't really stop the amount of times I eat chocolate. I don't eat it every day. I just once in a while, like a bag of M&Ms. And everyone's like that. And your fudge and your hot fudge sundae and your you know the other and all the coatings on every single ice cream in the freezer in the supermarket has chocolate covered something. You know, that's not going to change because it's not the main thing. People aren't sitting down and eating 1-pound blocks of chocolate. They're eating it as a ingredient with something else for the most part. And if you're buying a Dive or something like that, you don't care what the cost is either. If you're in there, how can you be in the store if you even care? I guess I'm getting older, but I don't have the taste for chocolate I used to have. I used to really like some certain chocolates, but like I find these days I'm like, yeah, you know, it's just chocolate. Which is sad because I used to be one of my favorite flavors. Could be COVID, could be aging, I don't know, one of those. Let's see. So anyway, so coffee up and up. Sugar was going up and up, but it kind of it slacked off, interestingly. From 28 to 20 is a pretty big drop. It'd be nice if cocoa came down a bit. Now, and you think about this, what's that like for Hershey? What's it like for Nestle, right? They're the ones paying for this stuff. Cotton has been generally pretty expensive. But you know, we had that big spike there, and that's why we started liking Levi's and stuff, because I was like, well, that's their main ingredient is cotton. Look at cocoa. It used to be reliably, you know, normally that price. Now it's double. It's literally doubled in price. Orange juice again. Weather is killing. You know, weather is killing us. Weather drives inflation. You got orange juice going up. Coffee is becoming a problem too, and we should have gone on that, frankly, when it was lower. Even here, though, we can go up quite a bit from there for coffee. Sugar is also a problem. There's a lot of problems. we have many problems. Cows are getting expensive again. The grains are not bad. Grains seem to be holding up all right. And currencies, the dollar is back, you know, again, consolidating for a move higher, because the rest of the world is really messed up. And especially China is going to have a huge problem. If they start bailing out these realty companies, it's trillions and trillions of dollars, you know, and that multiply it by 10 for how many yuan it's going to be. Doesn't matter though. But the point is that they're going to dilute their currency. They're going to weaken their currency, and we're going to benefit from that. You know, whether we want to or not, the dollar will get stronger. So anyway, so we were just right before the webinar, we were just discussing NYC Bank. And look what happened to them. They went from 1064 to 558. We missed that, but we caught it now at 650. Thanks to the sharp eyes of, who was it? Somebody mentioned it. That would have been the last thing I wrote. No. Oh no, I lost it. How is that possible? Because this is not this week. That's why I'm an idiot. This is absolutely, didn't refresh it. Let's try that again. See, last week I was saying how the market was unstoppable, still unstoppable. Okay, so here's today's article. And don't forget, we got the Fed coming up in a half hour, so lots of work to do here. Anyway, so we were talking about, right before the webinar, we were talking about this NYCB, thanks to the eagle eyes of Jeddah, who noticed that they were down 44%. Now, terrible earnings and dividend cuts. See, again, this is where it comes in handy to have my AIs well trained to do this sort of thing. So, and I said to him, so for the first 2 days, from Monday and Tuesday, I was rambling on about the China Evergrande and the commercial real estate situation and the open office spaces and blah, blah, blah. So this is exactly the repercussions that we're talking about from this. So NYCB, who has a lot of money lent out on New York City buildings, are they're basically battening down the hatches and getting ready for like a strike. Now, I imagine they're doing this now. There must be something in their portfolio that's going to take a big hit, and they want to be able to say we're well positioned to deal with this. But something has got to be happening in their own portfolio. Some building is going to go bust, or somebody's going to walk away, or something like that. And we'll find out what it is in the next few weeks, I imagine. Because this is some drastic steps they've taken to shore up their financials. It wasn't necessary. They took a $600 million provision for credit losses. I said, that sounds like they're expecting some shit to hit the fan very soon. But still, that doesn't mean the bank should drop number. I don't want to guess. NYCB, 7.5 billion. I mean, if you think about how silly it is, right? So they basically dropped almost, they dropped close to 50%. So let's say they dropped $6 billion in valuation. Over what? Over the fact that they took a $600 million provision? It doesn't make any sense. It's much too much. It doesn't, you know, how can they drop $6 billion because they took a $600 million loan loss provision? Now, you could justify that and say, well, it traded 10 times earnings, so 600 million would knock 6 billion off their market cap, but it doesn't quite work that way. Their earnings are close to $1 billion. Even if they took the entire 600 million as a loss, you're still going to amortize it over, let's say, 5 years, just to be super conservative, right? So it's 100 million a year. It's only going to knock 10%, 15% off their market cap, even if they lose the entire 600 million bucks. And frankly, the people, when you sell it off like that, you're taking the entire loss into account all at once. And that means me buying right now at 650, I don't give a crap why it got to 650, and I don't care about their prior losses. I care about the fact that next year they're going to make $954 million. And you're selling me the company for $7.5 billion because something happened in the past. So it's an overreaction on several levels, which made me kind of excited to do it. Now, I go to Shellbot and I ask him to give me a good, bad, and ugly report. Interestingly, he does not say this normally. He says this is a complex and detailed request that requires careful analysis, blah, blah, blah. He usually just gives me the report. So this was interesting. He apparently he took a look at it and said, this is a toughie. So now, again, don't take all this for granted. It still has to be looked at after the fact, because you never know for sure if their figures are right or not. You got to check their source, make sure they know what they're talking about. 6 hours ago, blah, blah, blah. You check the numbers, make sure that he's not crazy, but close enough. So this is the important point. This is why I like the good, bad, and ugly report, because he's basically starting out with, here's the good news. This was record income. They had record income. They had record earnings per share. They made $3.24 per share, and now they're willing to sell you those shares for $6.50. They just told you right now they made $3.24 a share, yet the response of the owners of those shares is to drop the price to $6.50. So the question is, was 2023 a one-time thing and now we're into like a catastrophe, or is their expected write-off of the real estate portfolio a one-time thing and then they'll get back to making money. And I say B. And of course, they picked up, they picked up Signature Bank and Flagstar Bank, and that we knew that was going to cost them money, and they're writing off that portfolio too. We knew this was all going to happen. It's diversified their loan portfolio. They've grown considerably in the last couple of years. They have a very strong capital position. The macro environment is in their favor at the moment. But they reported a loss with negative earnings for the fourth quarter because banks take a loss, and plus for tax reasons they want to take a loss before the end of the year. Why would you not take the write-off if you've got taxes due? It doesn't make any sense not to. It was due to a $600 million provision for credit losses. So they had a record profit year, and they took a write-off, which is a non-cash event, to say in the future we're anticipating this much losses from our loan portfolio of that bank we picked up, which doubled the size of our bank and will permanently make us more money. I mean, this is the cost of the acquisition. That's where it is. I give up. I just don't. I mean, I was saying that about traders with the Microsoft thing too. I'm like, for God's sakes, and the other way with Tesla, where they don't understand the valuation. It doesn't make any sense. But you can't react to earnings the way people do. For it's too strong, it's too weak, it's too this, it's too that. It's never going to make everybody happy. But that's our advantage. That's what we love, right? It gives us a chance to jump in and do stuff. They cut their dividends. Ooh, as another one of my favorite things. When a company cuts their dividend because they're like, well, we're paying out, I don't know how much. See, I get all excited like I'm going to say something important, but I don't know the actual number. Let's go to webinar. Here's Microsoft. What is this? Oh, because it's like Copilot now. All right. Stupid thing. Okay. How much money does NYCB pay out in dividends? Per year. 60th doesn't help. Another company recently announced a cut. We know that. Oh, that's nice and up to date. That's good, right? I didn't even ask that question, and it's giving me nice up to date data. Bing or Copilot now is getting better and better. It's really Microsoft is constantly making it better. It's very good. It still has no personality whatsoever, but neither does Microsoft. Can you tell me the total dollar payout? A billion shares, therefore $600 million, $700 million. So there you go. Okay. So they had a loan loss provision of $600 million, and they said, hey, you know where we can make up $600 million? We can cut the dividend, and we'll have that money right back in our account. Doesn't that make sense? You don't keep paying out a dividend if you need to put money back in your reserves to make your balance sheet healthy. That's what they're doing. They're voluntarily doing what the Fed would make them do if they actually have a crisis, right? The first thing the Fed says is, you're suspending your dividends while until you get all this stuff fixed up. They're saying, well, we're suspending our dividends because we don't want to go through a problem. So the amount they cut their dividend was essentially the amount that they've taken for a loan loss provision. And so they'll probably keep it cut for a year. And at the end of the year, if all goes well, they'll put the dividend back. And that's why, by the way, I love to take positions in dividend paying stocks when they cut their dividends, because the mentality of the company is that it's a dividend paying company. I mean, I'm talking about companies that are long-term dividend payers. So the mentality of the company is that they will generally pay 4 or 5% in dividends, but now they've cut it back to 1.5%, and people are bailing out. But I'm saying, well, I'll buy it now while everybody's out of the stock, and a year or two from now, they'll be back to 4 and 5%, and the stock will be doubled. So my stock will be doubled, and I'll be getting 5% of that doubled number. I mean, that makes nice sense, right? So if you can just be patient and work with these things, it's fine. The bank said the dividend cut was a decisive action to build capital, reinforce the balance sheet, strengthen the risk management process. I don't think any of this stuff is bad. Well, it's not. It's actually under bad, but to me, it's a smart financial decision, right? NYCB has regulatory challenges, higher compliance costs as it crosses $100 billion asset threshold. So as the bank grows, it's put itself into a category of bigger banks where it has bigger banks, bigger problems, and it has to deal with that and comply with a lot of stuff they haven't had to comply before. It's a growing event that's happening to NYCB. The ugly. NYC, their stock price plunged today. It says closing, unless it's psychic. That's an interesting thing. I'd like to see where it closes. Wouldn't it be funny if it's so good at predicting stuff that it like thinks it's in the past? It's like it's predicting something that as if it actually happened because it has a 99% confidence rate or whatever. The stock price has fallen since the beginning of 2024. It is trading at a price to earnings value of 2.1, well below the industry average of 11.4. How crazy is that? NYC's outlook, 2.1 is crazy anyway, right? Their outlook for 24 is uncertain. The bank has headwinds such as rising blah blah. But see, this is the worst. These are the worst things it can say, and it's not. It's dumb. It's really stretching to say bad things about the bank. So Shellbot says NYCB is a bank that's undergone significant transformation through 2 major acquisitions. They cut their dividend in order to prepare. Stocks plummeting. In my opinion, the current valuation is too low. Given the strong fundamental growth potential and competitive position, the bank's earnings per share is $3.24, which implies a fair value of $36.96 per share based on the average of 11.4. Even if we apply a conservative discount of 50% to the fair value, it'd still be $18.48 a share. And you're buying them for $6 now. I believe NYCB is undervalued and offers good opportunity to long-term investors who are willing to overlook the short-term volatility and challenges. I am so proud of Shellbot. I taught him all that, but it's just great to be able to see him consistently deliver a decent report. Based on the information provided, here's analysis of him. Oh, I'm sorry. Then I gave it to Claude, and I said to Claude, here is Shellbot's analysis, because Claude doesn't have access to the internet. I said, here's Shellbot's analysis. Here is the entire conference call from NYCB. And then I gave him an article from Seeking Alpha that was doing a top-down value analysis of them with the dividend cut and everything else. And it's from an author I trust. So Claude takes all that information and then comes up with this little note. Based on what's provided, the main concerns are from the large provisions for credit losses in the fourth quarter, driven by weakness in commercial loans, expected higher delinquencies. And he's dug all the way down into like the Q&A session of the conference call and all that. So he's saying they took a $550 million charge related to office and multifamily loans. The CEO stated from the conference call, we built our reserves to address office sector weakness and an expected increase in criticized loans due to repricing risk in the multifamily portfolio. This increased their ACL coverage ratio to 1.7 from just 0.74 last quarter. We recalibrated our qualitative factors with the office portfolio to address the issue and increase the ACL coverage. At least he understands this gobbledygook, right? Claude knows what he's talking about. Charge-offs also jumped in Q4 to 22 basis points. And 22 basis points is really not a big deal. 2 large loans drove the increase. A co-op loan and office loan, so commercial real estate quality is a mounting concern. So a couple of outstandingly bad investments are becoming a problem for them. The dividend cut, but that's the danger when you're lending to Manhattan real estate, when you have too much concentration in certain buildings. And by the way, it's not theirs, it's the banks they acquired had problem loans. The dividend cut was also a shock, but management searched this to accelerate the capital build and new regulatory requirements. He stated resetting our capital allocation was necessary to accelerate the building. So in summary, NYCD is battening down the hatches, higher reserves, reduced capital returns to shareholders in the face of commercial real estate. This conservative posture makes sense, but raises doubts if prior earnings will return anytime soon. That's a very valid summary. As to whether it's a buying opportunity, he says Shellbot sees a compelling valuation. Even 50% would be worth this. However, trapping value counters that the story has changed with such drastic dividend reduction in 4 quarters. Now, these guys are all about the dividend. Claude doesn't know that. I know that. And they expect it'll take 6 quarters to rebuild confidence. That's fine. I can wait 6 quarters. I don't have a problem with that. So in my assessment, income investors should avoid it until the clarity returns on credit costs. And that's true if you're in it for the dividends. It ain't going to come back anytime soon, for sure. But patient, risk-tolerant investors like us could consider a small speculative position given the extreme undervaluation, monitoring credit trends, capital, blah, blah, blah. Of course, you got to stay on top of it and pay attention to what's going on. But for us, I don't see why not. So my note to the members is in the short-term portfolio, we're just going to sell puts because we love to raise cash for the short-term portfolio. And the reason for that is the short-term portfolio is our hedges. So if the market goes up, our hedges do badly. And if the market goes up, then most of our short-term puts are going to short puts are going to pay off because the market went up and took most things with it, right? So we keep this cash, $5,000, against a rising market. Now, that doesn't mean any particular stock like NYCB can't tank or go bankrupt or whatever. Let's keep an eye on it, but it's generally good. And we think now we think it's a good enough value. And frankly, being assigned 2,000 shares at $8 is $16,000. It's not going to kill us anyway. In the long-term portfolio, we're doing a much more aggressive play, but it's funny because look, we're going to sell 40 puts, so we're obligating ourselves to buy 4,000 shares at $8, which is $32,000. That's only 1/3 of an allocation block in the long-term portfolio. So our worst case scenario is we get assigned a 1/3 allocation block in the long-term portfolio. And then we can start playing with it. But meanwhile, we're also going to buy 100 of the 5-10 bull call spreads for what's 280 minus 90, 170 on the $5 spread. And the spread is $1 in the money. So we're paying 170 for this spread that's $1 in the money after falling 40%. And if we get back to $10, which is where we started yesterday, if we get back to $10, it's going to be a $50,000 spread. And that would be a profit of $41,000, 455% in 2 years. And that is a very good upside potential. Now, in the income portfolio, we're doing what I said about the dividends. I don't care that they're not paying a dividend now. I intend to own this for 100 years. So at the moment, that's fine. So what we're going to do is we're going to buy 2,000 shares for $655, which is $13,000. We're going to sell 2,000. We're going to sell 20, which is covering 2,000 shares of the $8 calls for $1.40. So we're nowhere near 8, but we're still getting paid $1.40. Yeah, I'll show you. Trade NYCB. So here's the $8 calls. Just last one off at 137. By the way, these are 275. The $5 calls. I was tempted to do the $5 calls, but on the whole, I got more faith in it coming back than that. Over the next 2 years, I don't think I want to be, I don't want to give up $3 worth of positions to collect another $1.40. It's tempting, but I'm not that worried about it. So I decided to sell the 8s and give us more room to make money. So we sold 20 of the $8 calls, and we sold 20 of the $8 puts. So again, targeting $8, which isn't crazy because look where we are. Oh, wait, where'd the chart go? Oh, there it is. So look where we are. We're saying we're saying in 2 years we get back to 8. We're targeting, and 10 is where they were yesterday. In 2 years, we're saying we'll get half of that back. Half of that drop will come back. So I think that's the overreaction. I think people reacted twice as much as they should have to the bad news. Anyway, so we're buying 2,000 shares for $6.55. We're selling the puts, selling the calls. The net is $5,300. All right, so we're netting in for $5,300, which is $265 a share. So even if they finish at 5, we're not in bad shape, because we'll make $235 per share there, and we'll lose $3 here. Actually, I don't know. Yeah, no, we'll lose. We'll lose $3 here. So make $235 here. We lose $3 there. We're going to have a small loss at $5. $5 is still 20% below where it is now. So $5 is essentially our break-even point. Anything above $5, we make money up to $16,000. If it's over $8, we make $16,000, and that's a $10,700, 201% profit, plus $200 in dividends at a nickel a share, right? So $200. Oh wait, am I doing that wrong? No, it's 20 cents a year. 20 cents times 2,000 shares is $400, right? Yeah. Yeah, I shouldn't need a calculator for that. No. 20 cents, 2,000 shares, 10 cents is $200. 20 cents, $400. Yeah. Okay, so I did that wrong. It's not even the right number. So I have $400 in dividends as a bonus. And I went through the math quickly here. Even if we get assigned 2,000 more shares at 8, right? That would be an average of $5.32. What can I do if I get assigned, if I end up with 4,000 shares at $5.32? I just go and sell the $5 calls, 2027, 2028, whatever. I sell the $5 calls for $2 and knock off half the price anyway. So I'm not committing to owning it at even $5.32, because as soon as I own it for $5.32, I'll be able to knock it down to at least $4, at least. So my ownership is to own 4,000 shares for $4, which is $16,000. And that's all I'm really committing to here. So even if they go bankrupt, it's not going to kill us. But our upside is $16,000 if they just minorly recover. And that's what it's all about, guys. It's just taking advantage of a situation. We know NYCB, and by the way, NYCB was one of the banks I picked when we had the crisis last year when the banks all tanked. NYCB was one of the banks I liked the most. Why? Because they picked up Signature Bank's entire portfolio for pennies. It was basically given to them by the Fed. That's how they became. That's why they now, a year later, are having problems, because they're saying, well, now we're much bigger, and it puts us into a new tier of regulation that we now have to comply with, and so we're going to cut the dividends for the year. And I think frankly the CEO could have phrased it better, but they're also bound by regulatory constraints and what the lawyers let him say and so on and so forth. So you can't just get up there and spin it. You can't make it all sound positive. I know Elon Musk does, but or a CEO that actually cares about these things isn't going to do that. And that's where we are. So to me, this is an opportunity. A lot of most stocks say, well, I'm going to tell you, like, wait and see. Let's see what happens. I don't want to jump into it. Blah blah blah. This thing, I'm like, okay, let's buy. I certainly don't mind taking a starter position. That's all this is on these. It's a starter position. It's not a huge amount of money because it's a cheap stock. And frankly, because it's already the first, if they're still down next week, we're going to add this to the $700 portfolio as well. It's a great opportunity. If you see an opportunity, you got to jump on it. That's our job. That's what we're here for. That's why we have all these boring discussions all year long and talk about all these different things. What about this and what about that? And what do you think about that? Blah, 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 blah. And we talk about hundreds and hundreds of stocks. And the point is, though, that we get to know them. And then when they go on sale, we know they're worth buying. So here you have a live example of a stock that went drastically on sale and we jumped all over it. That's kind of the point, right? See if anybody's got questions. Nobody has questions. I am the greatest lecturer of all time. There's no question at all. I explain all this complicated stuff. Nobody has a question. It's amazing to me. You guys are weird. It's like I always have questions for people. Anywho, all right, so since we have no questions, we're going to move on to the petroleum status report. There we go. The weekly petroleum status report. And there it is. So despite Houthi activity, we still had, always make sure before you do anything, always make sure you're on the right one. So, right, so today's 31st, this reports to the 26th, that sounds right. Blah, blah, blah. So imports, no, well, let's just look at the number. I don't need to read that. So oil had a 1.2 million barrel build. Gasoline, 53 to 4.1 is a 1.1 million barrel build. Distillate fuels went down a bit from 3 points, so they went down 2.5. So these three things, can they be highlighted? How's that? There you go. So these three items cancel each other out. They're net zero. But look at this. All other oils, they went down. I thought they went up. They went down from 34 to 24. They went down 10 million barrels. So there was a draw in all other oils, and the SPR, the Strategic Petroleum Reserve, went up. So interestingly, so actually it's a net draw. I don't know why people are, so oil, frankly, is reacting very weirdly to a net draw. Whoops, charts. Where is it? I don't know. So what's going to make them happy? There is a net draw in oil. The headline is flat, but all of the oils, there's a big draw on that. So what's been happening? Now here, this is interesting, right? Last year, we imported 3 million barrels a day from other countries, right? Now we're only importing 2 million barrels a day. Look at that. Joe Biden has made us 33% more energy independent in 1 year. Right? You're never going to hear that on Fox News. Meanwhile, so we're importing, understand the math here, we're importing 1 million barrels less per day. We're exporting 400,000 more barrels per day. So the net change of imports to export is 1.4 million barrels per day. 1.4 times 7, 10 million barrels a week. Net oil is leaving the country, 10 million barrels a week. The difference, the net change of exports to imports. That is insane. And you can see it right here. In fact, there's the number right there. We were exporting 1 million barrels. Now we're exporting 2.3 million barrels, almost 2.4 million barrels per day. Net exports. That is insane. There is a glut of oil, and if we weren't sending all this out of the country, we'd be choking on it. We would have to fill our swimming pools up with it. Meanwhile, though, the price, of course, is, well, motor gasoline is better, 340. It was 340, now it's 309. They're not working around here in Florida, I'll tell you that. But the barrel cost is basically the same, and that means that this is bad for refineries. That means first quarter refineries, watch out, bad reports from refineries for this stuff. And Exxon, you have to realize Exxon is refineries are a big part of their business. That's why, in fact, Exxon is diversified, because they produce the oil. So if oil goes up and the refinery does well, then probably it's because the oil prices are too high, and that's good for them on the oil side, bad for them on the refinery side. If oil prices go down, the refineries tend to do well, while the oil division does poorly. And they also have a chemical division, which benefits from lower oil prices as well, and oil and gas prices. So that's the logic to Exxon's diversification, and several big oil companies are like that as well. So total production, nothing significant here that I would be banging the table about. We are producing about the same as last year. We're just exporting more of it. Isn't that, we're producing the same, but we're exporting a lot more. We're creating our own shortage in America. It's all fake. It's all manipulated. So, you know, when the Saudis say they're going to cut production, we're like, what do we care? Do you know how much of this oil comes from OPEC? Probably, I'd be surprised if it's half. Probably less than 1 million barrels. And all we have to do is stop exporting, and we're going to be just piling up with oil. So we are effectively energy independent now. We export more oil than we bring in by a wide margin. We're energy independent. That's what energy independence is. We don't need your imports. We don't have any need for any oil from anybody else. You know, and then every time somebody every time someone trades in a gasoline car for an electric vehicle, there goes consumption. You know, every time an office building, every time an office building goes solar, there goes consumption. Every time people switching plants and going to wind and so on and so forth, it's just grinding it down. And it's very abstract, but when the UN is talking about and the Davos people are talking about net zero by 2050, it's 2024. Over the next 20 years, we're going to stop using fossil fuels. That means, if it was consistent, 5% less per year. And oil is 100 million barrels a day. And we're going to use 5% less per year globally. The entire planet is focused on this problem. So that's what you call a macro trend. That's a trend that's going to last us for the next 20 years, and the trend is less and less and less oil consumption. And that's what, you know, the whatever they can do to raise oil prices, like start a pointless attacks in the Red Sea and so on and so forth. Of course, that raises the fear factor. It cuts off supply, disrupts stuff. It's great. It drives the price back up. But these are desperation moves, trying to keep the cash going. And that's how Iran supports these Houthis. So they tell them, it's like, dudes, if you want us to keep supporting you, you better do something about the price of oil. So start attacking some tankers. Start cutting off the passageways. Blow up some pipelines. You know, we call this renter rebel, right? That's just whatever it takes to get the price of oil banging back up. And speaking of manipulation in the market, I wrote about it this morning, but we're going to now look at the Fed meeting. And let's go to who should do the work. Oh, where is Claude? Where's ChatGPT? What's going on here? Weird. New tab. Thank you. Let's have Warren take a look at that. Chat GPT. Yep. Is that me? Yep, that's me. Okay. Fed meeting, FOMC, meeting calendar. Great. We have to go, oh, it's 2024. We have to go back to 2023. Let's go in the Wayback Machine. We have to get the, oh wait, we want the statement. We want the HTML version. And we're going to say, now watch, I'm going to show you something. Before I give him this, I'm going to say, we're going to examine the FOMC statement when it is released shortly. How much do you know about Fed speak and its effects on the market? And how much do you know about the current rate environment? This is putting him in the frame of mind. So by saying that, I'm causing him to call up data and bring it to his forefront of what he has on this information. So the prior statement on, what day was it? Well, it says it on the thing. Dun, 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 dun. Oh no, there it is. The prior statement on December 13th. Okay, Fed leaves rates unchanged, of course. We know that was going to happen. All right. The new statement is out. Here it is. Please highlight for us each change of wording and tell us what it means regarding the Fed's changing outlook. All right. Where's the frickin' thing? Here it is. Not like it's long, so we're going to read it too. But you know how I'm always looking for somebody to parse the Fed for us. Why don't we do that? It's so crazy. Got fast. All right, let's read it ourselves and see if we match up with Shellbot. We'll do the John Henry situation here. All right. Recent indicators suggest economic activity has been expanding solid pace. Job gains have moderated since early last year, but remain strong. The unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. None of that is going to give you a cut, right? The committee seeks to achieve maximum employment inflation 2% over the longer run. The committee judges that the risks to achieving its employment inflation goals are moving to a better balance. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. This is not good for people who want to see a cut. In support of its goals, the committee decided to maintain the target rate Fed funds 5 to blah, blah, blah. In considering any adjustments to the target range, the committee will assess incoming data, the evolving outlook. The balance of the rest of the committee is not expected to be appropriate to reduce the range until it has attained greater inflation. So the committee, I'm pointing, I keep pointing at the screen. It's like no point to that. The committee does not expect it will be appropriate to reduce the target range. Does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. That is a very big, very negative statement. And yes, the Dow is dropping. In addition, the committee will continue reducing its holdings of treasuries. And again, the tapering I talked about this morning in our morning post and described its previously announced plans. The committee is strongly committed to returning inflation to 2%. In assessing the appropriate stance of policy, the committee will continue to monitor risks emerge. The committee's assessments will take into account a wide range of crap, blah, 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 and there are no dissenting votes. Okay, what does Warren have to say about that? All right, all right, change in economic assessment. Previous statement, recent indicators suggest the growth has slowed. Recent indicators suggest that economic activity has been expanding. Now, think about that. They think that we have had from going from slowing to expanding economy in the last month and a half. In 6 weeks, we have had a substantial pickup in economic activity. This is not something that causes them to slow. They shifted from acknowledging a slowdown to emphasizing solid expansion. This signals increased confidence in the economy. Change in employment. Previous statement, job gains have moderated. New statement, job gains have moderated since early last year. The wording change reflects a slightly longer time frame for the moderation in job gains, but the overall assessment, blah, blah. Wow, that's like so picky. Change in risk assessment. The committee remains highly attentive to inflation risks. The committee judges that the risks of achieving its employment inflation goals are moving into better balance. The Fed now sees the risk of employment inflation goals moving to balance. This suggests they may be less concerned about inflationary pressure. Change in interest rate. The committee will take into account cumulative tightening. The committee this is a big deal. The committee does not expect it will be appropriate to reduce the new target range until that's exactly what I just highlighted. The Fed is indicating that they are less inclined to reduce rates until they are more confident inflation on sustainable path towards their 2%. This suggests a cautious approach. Overall, changes in the statement indicate a more positive outlook on the economic activity, a balanced view on risks, and a cautious stance on interest rate adjustments based on inflation sustainability. This shift in language suggests the Fed's confidence in the economy, but maintains vigilance regarding inflation is essential to keep monitoring these. Yeah, well, no shit. So, given this information, at what point do you think the Fed will consider lowering their target rates? Don't be vague. Because he was saying the Fed will lower the target rates when they see it appropriate. The Fed's willingness to lower the target rate will depend on their assessment of inflation at a specific timeline. All right. So it seems they are going to base the decision very much on inflation. So please tell me what inflation trends you are seeing from the most recent economic data you have access to. No. Use the web. My current environment doesn't allow me to browse the web. What the frick? Oh, it's the wrong ChatGPT. Damn it. All right, I don't feel like doing that again. Anyway, shit. I don't know how he got on the wrong GPT. All right. So that was the problem there. How about plugins? Oh, there's my plugins. He wasn't even have his plugins on. Oh, I'm going to make him read the whole other thing. Punishment, you're going to have to read the whole section. Okay. Here's our last session. You were accidentally accident. Okay. Whoa. Oh, that was him reading it. It was long. That's how it should work. So, you know, when you pay for the GPT, you can put up these, you can load plugins, and the plugins I have running now are Mixerbox Web Search, Mixerbox News, and Wolfram, which is a statistical analysis. It's not the ones I wanted to run, but that's what's running. Where is your thing? Okay. So the CPI is scheduled, don't tell me that. Based on these, so okay. Oh, based on these sources, inflation is showing signs of easing, particularly drop below 3% in December. This aligns with the Fed's cautious approach to monetary policy. So you likely wait for more concrete evidence before considering rate cuts. This data should be valuable in your analysis. Yeah, I know. How about looking at the things that make up the CPI and let's anticipate what it will show in the next report. So now he's telling me housing costs, energy prices, food, transportation, apparel, whatever. Given these components, here are some anticipations for the next CPI. If energy prices stabilize or decrease, any disruption in food supply chains or agricultural. Okay. Or more detail, it would be ideal to examine recent reports. Yeah. Good idea. Please do that and present your findings. There we go. Now he's doing some work, right? Home prices, it's crazy. Home prices are 40% up since 2020. Based on these trends, it appears the housing market is experiencing a mix of rising home, and the impact on CPI would depend on the balance of these factors. And it's still not giving me a good answer. Overall market, realty got stuck on homes for some reason. So, but this is useful. Bank rate, median home sale price as of November was 387, a 4% increase from the previous year. The steady increase contributes. Rents are predicted to remain stable and rise slightly. So nothing's going down. Mortgage rates, predicts mortgage rates will fall. There you go, to by the end of 2024. But that's a very slow fall. This decline in rates, the National Realtors expects existing home prices to increase by 1.4%. So things are still just creeping up. And we saw that the wages are creeping up. So this is not a trend that's going to lead us to think the Fed is likely to pull back anytime soon. Let's see. Oh, we have a question. Jean-Philippe. General question regarding the $700 portfolio. What would be the strategy to apply when we are not able to get the right prices to cover our positions? Wait until we get it, assuming that these are safe positions. Lower our price target. For example, yeah, that's the thing. It kind of depends to some extent, but I got 5 Pfizer, 2026 $30 long calls for 382, and it's uncovered. Yes. So you have to think about, and you're doing it, that's correct. You have to think about what was our intention. So our intention was that we're bullish on Pfizer. And so if you get the price on your long calls, if you get a good price on the long calls and we're bullish, then wait. Okay, in theory, earnings will justify the price and we'll see Pfizer move up slightly. So I don't know when I made that call for Pfizer, but let's just take a look at where they are now. Not there. Not there. One of these things is going to give me charts. So if I go to the Dow, what am I going to get? It doesn't do that. Home news. Oh, here you go. PFE. That's where you put it. Very, very different layout. I just have the single screen here, so I get very confused sometimes about where things are. All right. So when did we add it to the portfolio? Let's see. So that was January 9th. Okay. So on January 9th, oh, I see. It hasn't gone well since January 9th. Which day is January 9th? January 17th, 9th. Ew. Okay, so on January 9th, we added the calls and Pfizer's dropped $2 since then. So that's upsetting. And what was the position we took? We took the 30-35 spread. Well, you can't adjust that really. We took the 30-35 spread for $4 and $2.35. And you said that you got the calls for 382. That's fine. And the question is, how much are the short calls now, the 35s? They're certainly not going to be good right now, are they? So Pfizer, not FIAX. Oops, fading. But my voice is holding up, so that's a big advantage, positive. All right. So the 35 calls, ooh, yuck. They've dropped down to 176. Yeah, 380. So you're 80 cents down here. It doesn't make sense to do this cover. You're better off waiting for them to come back. And I know that sucks, especially when you lose a buck. Let's see. Pfizer. Oh, no, we said this. When's the earnings date? That's what I want to find out. I like this FinViz, by the way. The calendar in FinViz, which I don't think you have to pay for, but if you just go to FinViz and do this search, you get this calendar, which this chart, which I started to use more than the others. And oops, they did just have earnings. See how nice this is, though? So they just had earnings. January 30th. And, oh, that was yesterday. And they had a beat, a very large beat. And I don't understand what's wrong with people. Revenues were down a bit. But, you know, I mean, honestly, when I see like a 1% miss in revenues, it's like, what are you going to do? It's like, you know, 1% plus or minus is not something you should be worried about. This is very nice. They earned 25 cents more than people thought they were going to earn, yet still, you know, well, I mean, they're not, it popped up to 28, then it came back down to 27. So we'll just have to wait. But I think that if you just sit back, people are going to stop freaking out about Pfizer and it's going to come back to the 30s. So again, it always depends. It depends on when are the earnings, what's the situation, so on and so forth. But you got 2 years on the trade, so I would just be patient. Like I said, what do we get for this thing? We got, you know, we only got 235, and it's 175 now, so it's down 60 cents from where it was. You could, I was gonna say you could sell the earlier year, but that doesn't mean it's not worth it. I would wait. I would give it a chance to bounce out. They're up today. I mean, realize that they had earnings yesterday. Today is not a particularly good day in the market, and they're up 1.3%. You know, so clearly, and those earnings were good. So clearly, we're on the right track, and it's just a matter of being patient. And if not now, then later, but eventually you sell it. Of course, until you sell it, you're not able, you know, you have that much less money to spend because that was money you're supposed to recoup. How is this thing doing? It's doing all right, holding up well. Oh, see, UNG down $1,000, costing $1,000 in UNG, and we're gonna have to double down on it or something. That's annoying. All right, what else did we talk about today? So yeah, you know, earnings are kind of all over the place, but you know, and companies even that have good earnings, like Starbucks had good earnings, Microsoft had good earnings, they're still going down or getting punished. Actually, Starbucks I don't think is. Let's see. Charts. SBUX. Oh, yeah. Flat. You know, I mean, they had great earnings. I don't see what's wrong with people. Boeing, oh, there's a good one. Boeing. People are now surprised they're making any money. It's so funny. It's like, they're like, really? You guys have a business? So they're up, what, 6% today? That's very nice. I'm still scared to buy them. I mean, it's just the string of incompetency at the company. Microsoft, I don't know what do you have to do? That's crazy. Nope, not that. Let's see what Seeking Alpha has to say about Microsoft. Chinese blah blah blah. Microsoft discussing investing in startup, building robots. Microsoft's masterpiece results. That's an interesting way to put it. I like that. Okay, Microsoft earned $293 on $62 billion in revenue. Overall cloud revenue rose 24%, 24% in 1 year of cloud revenue. And by the way, that's because it's, now notice this, it rose 24% to $33 billion, right? Why? Because last year they gave OpenAI $10 billion and said, okay, here's $10 billion. We now own a substantial piece of this thing, and you're going to agree to host your system on Microsoft. So now all the increases in AI usage and all these companies that want to hook up to OpenAI and so on, they're being drawn to Microsoft's cloud, and they're picking up more than $10 billion in revenue in 1 year after they put $10 billion into OpenAI. Some of that revenue is OpenAI paying Microsoft $1 billion, $2 billion a year to maintain their cloud infrastructure too. So they're going to get all the money back, and they've turned Bing into a viable competitor in the search space. I mean, what a brilliant strategy they used. You know, and you can do that when you're as big as Microsoft. It's crazy. So that's not even the intelligent cloud segment, 25.9 billion in sales, blah, blah, blah. And Copilot hasn't even started yet. Copilot's going to make them $20 a month from everybody who uses Office. Because now you've got an AI assistant built into Office, and not the stupid stuff that we've seen with these plugins and stuff. They're building it physically into Office. So when you're in Excel, Excel will be able to talk to you and help you, you know, put spreadsheets together properly and so on and so forth. When you're in PowerPoint, you're going to say, how about this font? How about that font? You may be able to talk to your PowerPoint and have it change stuff for you. It'll be able to put a picture in, it'll be able to make a graph for you, because you'll talk to it and say, could you make a graph out of this data? It'll be like, yeah, sure, no problem. Here you go. Who's not going to pay for that? Not everybody's going to do that. I mean, there's a lot of people who casually use it. That goes for Word and formatting and so on and so forth. It's like, you'll never have to look up again and say, go through the instructions, say, how do I fix this or how do I do that? You say, could you fix that so it's like a little more indented and stands out a bit? And how about blue? How about green? How about purple? Try some stuff. Why don't you make up a font for me? That's what it's going to be like to use Office now. I mean, it's crazy how advanced this is becoming. And think about the productivity gains from that kind of stuff. Think about how much less wasted time to get stuff done when all this stuff it can be automated. So this guy's target is 440. And so on and so forth. Anyway, I mean, just 440 is only 10% higher than it is now. But this is, I mean, you can't do better than they're doing. I don't understand what people would expect of them. But again, it's trading at 36 times earnings. It doesn't matter how good they're doing. It's still, as we were talking about, it's just still too much money. That's what the problem is that it's that all this is built in already. It's like, so you haven't impressed me past this point. I already gave you the benefit of the doubt and traded you at $400. What else are you going to do for me? And unfortunately, the entire market is like that. Everything is priced at crazy numbers, which we were discussing this morning. Apple, what is this darkness? Okay. Apple trading at 30 times earnings. At least it's 28.5, but Microsoft's 36. 36 is too much. 28 is too much. But somebody, and this is what Elon Musk is bullshitting about. And it's I mean, I guess he's been going through this this trial about his compensation, and he lost. And that's why he's been lately, pissing about Tesla has to give him more stock, and they got to do this and they got to do that. And he has a bit of a point, because he's building a robotics division. And he's like, why should I, just like SpaceX is completely different. So in his mind, it's a precedent. I'm not arguing the logic of what he's saying, but he's basically saying, why should I build a robot division for Tesla that's going to be as big as the car division, 100% more for the company, instead of starting my own company, instead of doing what SpaceX is? He's like, He's like, I've got $100 billion. I could fund this startup. He goes, I don't need anybody here. I don't need anything here. So, that's his interest in this situation. So he's basically saying, if you want me to stick around and do this inside of Tesla, you're going to have to compensate me to stick around. Which is weird. Now, on the other hand, you have to say to yourself, well, perhaps Elon Musk has, obviously Tesla is a majority of his wealth. So it's not like he's going to just walk out the door. And that's also because robotics is not going to be a significant thing. It will take, how long did Tesla take to get going? Like 10 years to get going. It'll take him 10 years to get a robot company going. So it's not going to make sense for him to go out and quit Tesla, or effectively quit Tesla, start up a robot company, spend 10 years on that. I mean, how old is he? He's got to be close to 60, right? How old is Elon? 52. Well, he can do that then. But anyway, so he's at the point in his life. In that case, he's at that point in his life, right, where he's going to say, you know what? Am I going to put 10 more years into Tesla, and they're not going to reward me for what I'm doing? He's pissed off. He's pissed off about this compensation thing. The argument is, and the bonus compensation is $56 billion. That's insane. The judge pointed out that is the total compensation. No, not the total compensation. It's the valuation of all the other car companies in the U.S. combined. That's what Elon Musk wants to be paid for running Tesla. The entire, not the salary. He wants the entire market cap of the American auto industry as a bonus. And the shareholders are suing him, and the shareholders are saying, this isn't right. It was a self-dealing contract. He controls the board. They're his guys. They rubber stamped it. It's not in the interest of the company at all to have entered into this agreement, and it's not fair to the shareholders because he's diluting the stock by 20%. In order to give him its stock compensation, but in order to give him the compensation, they're giving 20% of the company to Elon Musk as a bonus for doing what he was supposed to do in the first place. It really it is beyond belief, like, that he even had a contract like this in the first place. That gives him that. No, but it doesn't happen. It's not right, and the judge was right to throw it out. But he's pissed, and him being pissed means Tesla's got problems, because you've got a disgruntled CEO who's running around and threatening to quit and take his engineers with him to start working on a robot company. Now, what's going to be in Elon's head? He's got, Pal's coming. We started already. What is going to be in Elon's head? He's got $200 billion. Most of that money is in Tesla stock, but he's got good liquid money. He's got SpaceX too. That's a whole nother thing. So he obviously can quit Tesla and appoint somebody else CEO, take some damage to, let's say he takes $50 billion worth of damage. He's still worth $150 billion. Then he starts his robot company, which he firmly believes is going to be a $100 billion robot company. And that's his logic. And he's saying to Tesla, he's like, my options are get 100% of my $100 billion robot company, obviously diluted when he gets investors and stuff. But he's like, I either take this robot company and do it and own it going forward, and the robot company is probably going to be bigger than Tesla over time, because not every home may drive a Tesla, but effectively every home will have a robot. And he's got an even footing for market share with anybody else that's trying to build a robot, and he of course thinks he can do better, whatever. So household robots, anybody who pays to have their house cleaned knows that if you could go to the store and buy a $25,000 household robot that'll clean your house and mow your lawn and get your groceries and so on and so forth, you're going to do that. Even if it's a $50,000 robot, frankly, it's very justifiable to take all that crap off your plate. But they're saying they can do it for $25,000. The only issue with a $25,000 robot is that it would rely on an internet connection, but that's where his Starlink thing kicks in also. But a less expensive robot would rely on an internet connection being available at all times, which you might think could limit the going to stores and stuff like that. But they're going to solve the problem for cars. They're going to have to solve it. If they solve the problem for cars, they're going to solve it for robots too. So it's going to be very interesting. Anyway, the world is going to get extremely interesting. But that's what Elon's deal with the board is right now. So we talked about that, and we were talking about the Fed, but now Powell's talking. So let me see if he has anything important to say.
Inflation is moving down.
The Fed is fully committed to bringing inflation back to 2%.
Expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as
the economy has made good progress. Inflation has eased, but the path forward is uncertain.
Mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
The 10-year is at 3.97%.
Both sides of our mandate. We're strongly committed to returning inflation to our 2% objective.
Labor demand still exceeds supply.
Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
At some point here. That's actually not a bad statement.
Since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
Longer than late this year.
Has eased and progress on inflation has continued. The risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
Ooh, that's harsh.
Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
He's talking second half of the year at best for lowering rates.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country.
All right, to conclude, whatever. All right, so then there's going to be the Q&A after that. So the action on the market while he's talking, as you can see, we're pretty much on the lows on the S&P here, lows on the NASDAQ, and he's not really helping so far. And he's not going to help. What he said, what they said what they should have said. But the point is, let's get back to that. All right. So the point I was making today, which is really, really important, and we'll conclude with this, Oh, here I was talking, oh, this is good too. I was talking about Tesla and, so in addition to most salary issues, you got to realize that Tesla is being valued at 60 times earnings. 60. It takes 60 years for them to make back the money you give them at the current price. Stellantis had a good day. And it's silly because the reality of Tesla is they're a car company and they're a heavily subsidized car company. Those subsidies will eventually go away. And even if they don't, other companies will start taking advantage of them. They'll start building cars to take advantage of the subsidies. It's not. I said it's not like he's Henry Ford and his competition is a bunch of guys working in a garage hand making cars. It's everybody knows how to do what he's doing. Everybody could do what he's doing. They vary on their approaches, and the different auto companies they've got considerations with unions and so on and so forth. But in reality, like Toyota can do whatever the hell he wants. If Toyota wants to build all robot factories for all across Japan, the Japanese people are going to be like, yes, because whatever Toyota is the economy of Japan. They're going to do whatever they want to do. They're like Samsung in Japan. I mean, they just, whatever they decide to do is going to be fine with everybody, especially the government. But on the whole, Tesla is, and people forget this, they're a car company. They make cars. Cars have poor margins. For a while, they had a unique car and they were able to charge a premium, and a lot of people bought it and they made a lot of money. But now competition sets in and the exclusivity and the premium price they get to charge is starting to wear out. And eventually they'll go back to the normal margins of a car company, which is roughly 7%. And you can do whatever you want. You can automate this and automate that. And the 100-year history of making automobiles is that they automate it, they cut cost, they do this, they bring out different models, they figure out this, they charge that, and every single time the other companies start catching up and start competing, and they all cannibalize each other's profits. That's the reality of a business when everybody can make billions of dollars. It'll just go to the person who's willing to make the least number of billions is going to win. And it's not like they don't make a lot of money anyway. They make, talking 10 billion here and 30 billion here for these companies. It's, nobody's losing their shirt, but also when you're making ridiculous excess profits, then somebody else is going to say, okay, we'll do that too. And they'll start taking part of your excessive profits. That's what capitalism is supposed to do. And that is how this works. But these Tesla fans don't believe in capitalism. They think that Elon Musk is going to maintain his market advantage forever. It's not going to happen. The bigger they get, the more like a car company they get, the lower their margins are. And it doesn't matter if they make more money, it's fine. But it's tricky because they have 4% of the market now. And so to justify their current market cap and get to a PE of 20, they've got to get to a 12% market cap. They've got to get to a 12% market penetration. So the question is, which car companies are they going to wipe out to get to 12% from 4%? And what are those companies going to do about it to stop Tesla from taking their market share? You're talking about the other car companies that have 96% of the market. He's got to take 8% from them. Almost 10% of their business has to go to Tesla over the next what? And it's taken Tesla how many years to get to 4%? How fast do you really think they're going to get to 12%? But you're paying for 12% now. It's not mathematically viable. So meanwhile, back to the Fed, the thing about the Fed is, they can't just say, we're going to charge this rate, we're going to charge that rate, because the rate is what sets the notes. And the 10-year note is right now paying 4%. If 4% is not attractive, then nobody's going to bid on the 10-year note. And if nobody bids on the 10-year note, they have to raise the rate on the 10-year note to attract bids. They have to sell the notes. We already spent the money. This country is already massively in debt. We already spent all this money. We already borrowed the money. Most of the money, it was we sell, and this is stunning. We sell $5 trillion worth of notes. 500 billion, sorry, 500. We sell $500 billion worth of notes every single month. Okay, so let's put that in some kind of perspective. Okay, GDP by country. Okay, so every month, $500 billion worth of notes. The entire economy of Thailand, the entire economy of Nigeria, Egypt, Austria, Israel, Ireland, Belgium. This is how much we're selling monthly. In 12 months, we're selling $6 trillion worth of notes every 6 months. Every year. That is bigger than the entire economy of Japan, bigger than the entire economy of Germany, India, UK, France, and basically we're selling more notes than the third largest country on the planet, than their total GDP. And that's what we're asking for every year in cash for our notes, because it's $34 trillion worth of debt that rolls over every year, plus another $1.7 trillion of fresh borrowing. But the 34 trillion doesn't roll over every year, but there are 5-year notes, 2-year notes, 1-year notes, 2 months notes, 6 months notes. That's why it happens. Those notes constantly roll over. Why do they roll over? Because the government doesn't pay off. We cash in, the notes mature, and we pay them off. Yes, we do pay our debts. When the notes mature, we pay them off. But how do we pay them off? We sell more notes. We don't have the money to really pay off the notes. We're just selling more notes, and then we take that money and pay off the current notes, and then we take that money and we pay off the current notes. And what does that do? It accrues more and more and more interest. Isn't this crazy? Like, this is a completely insane economic system that we've developed for ourselves. So, point being that we're selling 10-year notes at 4%, and there's a wide range in example, but let's say just realistically, if you think about it, you're lending the US government money and they're paying you 4% a year for 10 years. You have to believe, A, the dollar is going to maintain its strength because you're going to get paid back in dollars. So the dollar has to remain strong for 10 years, and 4% has to cover the inflation. So if you don't think the dollar is going to be strong and you don't think 4% is going to cover inflation, you're not going to buy those 10-year notes. So the Fed has to get you to believe that inflation will be below 4% to keep people buying their notes at 4%. The Fed also has to have you believe that they are going to lower rates. So you better buy your 4% note now, right? They want you to believe that they're going to lower rates down the road, and that lowering the rates will not weaken the dollar, but that makes no sense. So it's just a bunch of gobbledygook, and that's why they're so obscure in their language and so on and so forth. You can't discuss this straight out without it sounding ludicrous, because it is ludicrous. I keep expecting the guy to appear behind me because of that commercial. So the bottom line is that we borrow a staggering amount of money, and we borrow it every single month, and people have to show up at these auctions. So if the Fed lowers the rate, the Fed funds rate of 5.25 that determines where all the other notes are. If the Fed lowers those rates below the tolerance of the people who are buying the bonds, then the auctions begin to fail. And if the auctions fail, then the Fed completely loses control of the situation, and they'll no longer be able to talk down the markets and talk down rates by just saying they're going to do stuff, because they'll say, well, you guys are obviously off track and incompetent, and now you can't, and now nobody wants to lend you money. This is what happened in Greece. The loss of confidence in a country and their ability to regulate their economy, that's what happened in Greece. And all of a sudden the lenders said, no, 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 we don't want 5%, we want 6%. Then a month later, 7%, 8%, all the way up to 20%. Greece had to sell bonds, same situation we have. They have to sell bonds every month because they don't have the actual money to cash in the existing bonds. So they have to sell bonds every month to pay the other bonds. But what happens when you sold a bond for 5% and now you have to pay that guy back his full balance plus the 5%, and you have to now borrow the full balance again, but the next guy wants 10%. That is not an immediate problem, but when that bond has to be redeemed, now you're paying him the 10%. And then things, and because of the 2 month, 6 month, whatever bonds, the 3 month notes, the 1 year notes, the 6 month notes, the 2 year notes, because there's this constant rollover of notes every single month, $500 billion every single month in America. It escalates hard and fast, and it hits you incredibly hard. And that's why, was it yesterday? Yeah, I think it was yesterday. Look at my voice still going. I'm so proud. Oh. Really? What's going on here? Oh, yeah. What's going on? So slow. Anyway, so that's why yesterday, ta-da. Oh, what is up here? Nope, it's not going to happen. Oh, wait, orthophil. There you go. I hope it was yesterday. We're moving, by the way, speaking of clouds, right? We're moving to Amazon Cloud because this is happening. Rackspace got bought by somebody, and I don't know what they did, but they've gotten slower and slower and slower. You know, we have an old-fashioned server or servers on Rackspace, but for whatever reason, since they got bought by somebody, where, you know, whatever they've done to cut costs or justify their expenses is not working out for us. Anyway, I had a chart that showed how rapidly our debt interest payments are going. So in other words, the interest on the debt that we pay now is $1 trillion a year. We, the United States, are paying $1 trillion a year in interest alone on the money we've borrowed, on the $34 trillion we borrowed. It's only 3%. It's actually not that bad considering how much we borrowed, but that's the problem, because the creditors look at you and say, well, you know, you're $34 trillion in debt now. So it's such a big number. So you're $34 trillion in debt now. Oh, I know what it is. Look at that. It's not a very good internet connection. Oh, please tell me it's here after all that. So annoyed. That wasn't even the right place. But anyway, so we were paying 2 years ago $350 billion a year. which is not nothing, but it's better than that. There it is. Yeah. So here, before COVID, we were paying $400 billion a year in interest on our debt. Now it's $1 trillion. So that's 600 billion more every year, just interest on debt. And this is a rollover. Eventually, all of our debt is going to be 4% or higher. And that's going to be 3.4 times 0.04. $1.34 billion. So eventually, and it happens fast because most of our debt short term, but we're going to be up here. That's why we got this. Ay caramba. That's insane. And what happens if rates go high? Don't forget, in 1980, here in the 1980s, we had a interest rate of 15–18%. Fed funds rate went down after it peaked at 18. It went down pretty quick, but we had a couple of years in the teens of interest rates. A couple of years in the teens of interest rates would add $3.5 trillion a year of debt, just of interest to our debt. It would be debt because we have no way of paying it. So we could quickly add $7 trillion worth of interest to the national debt just by having to pay off 10% for 2 years. And so you're asking a person now to lend you money at this rate, even though you are now double in debt. That's not going to continue. It's not sustainable. Therefore, the Fed funds rate is bullshit. It doesn't reflect a real market. The Fed has been buying all the the Fed has been buying a good portion of all the Treasury notes that come out, and they're not doing that anymore because now their balance sheet is $9 trillion. And that's basically debt too, but it's a pretend fake debt that the Fed doesn't have to book it. There's a disaster. It really is. And the more people talk about it, the more people realize it, it can become a huge problem, especially if China implodes, the real estate market in China implodes. Then there's a whole huge source of treasury buyers that won't exist anymore. You know, those people are going to put their money back into China and back into Chinese real estate and try to salvage it, and the Chinese government and so on and so forth. You know, we're going to lose that pool of buyers. Europe will probably be affected by China because their banks are all tied together. So that would hurt that pool of borrowers also. Then who's left to buy our debt? Who's big enough to buy our debt? Who has that kind of money? Nobody. It's not a question of willingness. There's not enough money in the world to keep buying our debt at this level. $500 billion every single month has to be given to the US government in exchange for pieces of paper. It's not sustainable. And as you have to dig deeper and deeper into people's pockets to satisfy your constant requirements of debt, then those people are going to start asking for more and more. You have the anxious people who are happy to buy your debt, but you run out of those. They're tapped out. They're buying as much debt as they possibly can. Now you have to go after the people who don't, are like, I don't think so. You know, it's like lending America money at 4% is not my plan for life. Now that's most people. Most people are going to tell you that they're not very interested in buying our debt for 4%. We haven't had to force them before, or entice them. Let's say entice, not force. We haven't had to entice them before, but now we are borrowing significantly more money than we used to borrow. And that money means we have to dig into new sources, and that means we have to pull those new sources off the sidelines. And the only way we can do that is by raising rates. And so in other words, if you can't sell your notes at auction below the Fed funds rate, then the Fed funds rate has to go up. Otherwise, the Fed is revealed as being completely ineffective and everything collapses. All right, that's fun. What a great way to end the webinar on that happy note. All right. John Philippe says waiting to get a good price to cover. And Andrew asked for further thoughts. That's hard. There you go. That's a tongue twister. That's why. Further thoughts on Vail. I don't have any thoughts on Vail. Did they have earnings? Let's see. Let's see. Up. We took away my FinViz charts. I can't do anything. Nope, there it is. Vail. So, when was earnings? I saw them before. Now I don't see them. Earnings October 27th. Oh, they don't have a date yet. October, November, December, January. All right, so late January. No, I don't have any thoughts. They basically, you know, we came in November, which was where? Here. So we came in around Thanksgiving. At here, they've gone down $1 since then. I don't have any particular thoughts. I think that the China slowdown story and the crisis in China is spooking everyone because it's, you know, 60% of their business is in China. But I think that China's response to a real estate collapse is going to be massive infrastructure spending. We're doing that. The whole world is doing massive infrastructure spending because we have to build wind farms, solar farms, more, you know, like nuclear plants, things like that. We have to build up the infrastructure. We're building more dams for hydroelectric projects, oh, there was another thing I was thinking of and I can't think of it now. Anyway, so huge infrastructure projects going on. We're not gonna stop using iron ore, and it's going to be a part of the bailout projects to build large scale infrastructure. So I don't see that going away. I just think that we are basically consolidating the bottom of the channel, and I think earnings should be you know, and again, iron ore prices, this was our premise in the first place, iron ore prices are significantly higher than they were last year. Therefore, how are these guys not making money? All right, so that's my outlook on Vail. All right, so good. There's a more positive note than ending it with the fact that we're doomed and we're in a debt spiral and everything is going to fall apart at some point. All right, so keep the Vail in mind, forget about the debts. Forgetting about the debts is the American tradition. Let's not worry about it. All right, have a good day, everybody. Thank you.